Stock markets remain volatile following Donald Trump's global tariffs. China accuses the United States of blackmail over a threat of additional tariffs and vows to fight till the end. Meanwhile, African nations are actively addressing tariff challenges while driving diversification as economic uncertainties rise. Hello, I'm Taiba Aiden with the latest business and finance news here on TRT World. In the United States, a new wave of tariffs is also hitting the green energy sector. They come with the sector already facing challenges. Investment in renewable energy is at risk due to likely cuts in government incentives and a shift back toward fossil fuels. Tariffs ranging from 10 to 49% are set to raise electricity prices, already climbing faster than inflation. This may derail efforts to shift away from fossil fuels and strengthen clean energy alternatives. One of the hardest hit sectors is battery storage, which is crucial for the success of renewable energy. More than 90% of the lithium-ion cells used in the US are imported from China. And with tariffs soaring as high as 82% by 2026, this dependency becomes a serious vulnerability. Solar and wind industries also rely heavily on imports, particularly from regions facing tariffs such as China and Southeast Asia. With limited domestic production capacity, the cost of executing projects is likely to rise. Under President Trump's administration, fossil fuels are taking precedence. His policies favor oil and gas exploration while dismissing climate deals like the Paris Agreement. His focus on energy independence shifts the country away from clean energy. Since 2016, US oil production has surged by 70%, positioning the country as the world's top producer and exporter of both oil and liquefied natural gas. Analysts are warning that US President Donald Trump should not go ahead with his tariff plans, fearing more economic uncertainty. The head of JP Morgan has come out and cautioned that his policies are going to slow growth and push prices up even higher. The effects of Trump's tariffs are being felt across the world. Trillions of dollars of value was lost in Monday's stock market shock. And as Emirates reports, economies are bracing for more trouble ahead.
As markets opened for the week, across the world, traders were on edge, and they were soon coping with a disaster as stocks plunged to record lows. US markets alone losing $5 trillion. The S&P 500, an index tracking 500 of the top US companies like Apple and Microsoft, plummeted by more than 14% from its recent peak. This was all triggered by Donald Trump's tariffs on 185 countries, sparking a massive sell-off. So where did the money go? It went into safe haven assets like gold, US Treasury bonds, and currencies like the Japanese yen.
This is in large part on the back of both the tariffs to begin with, but also the prospect of retaliatory tariffs coming in from China and also from the EU. Now, certainly, if the US strikes deals, and it's been reported that some 50 countries have tried to call President Trump to strike a deal, if deals do start emerging, then potentially we could start to see a flaw in the stock market.
But for now, investors are pessimistic, anticipating lower corporate profits. This is despite Trump believing the tariffs will bring wealth to the US.
I don't want anything to go down, but sometimes you have to take medicine to fix something. We're the piggy bank. We have all the advantages. Forget markets for a second. We have all the advantages. We'll get it straight out. We're going to become a wealthy nation again. Wealthy like never before.
So what does this mean for the US economy? The outlook isn't good. The tariffs will immediately raise the cost of imports, hitting consumers and businesses. The latter have no choice but to pass on those costs to consumers, leading to weaker domestic demand.
While uncertainty remains elevated, it is now becoming clear that tariff increases will be significantly larger than expected. And the same is likely to be true of the economic effects, which will include higher inflation and slower growth. The size and duration of these effects remains uncertain.
The Fed last month kept rates unchanged at 4.25 to 4.5%. But given the sluggish growth environment, analysts expect it may need to start cutting rates. Donald Trump has urged it to act. If rates fall, borrowing will become cheaper, potentially driving up prices even further. Analysts are already concerned the US may be heading into a recession, with JP Morgan raising the probability from 40% to 60%. And with the US contributing more than 26% of world GDP, this could set off a ripple effect across the world. Emre Boz, TRT World.
To discuss this further, we're joined by Steve Keen in Amsterdam. He's an economist and honorary professor at the University College London. Good to have you with us, Steve. Now, are these tariffs really going to help the US economy grow in the long term, as President Trump claims?
No, they're not, because they're going to disrupt global supply chains, and that's going to have more of a damaging impact. Tariffs in the 19th century this way may have worked, but not tariffs like this in the 21st century. But the basic principle that Trump is working on, that trade deficits are damaging the American economy, is correct. So I don't think he's going about changing that in the best way, but he's certainly focusing on something which matters.
And how quickly are US consumers expected to feel the hit of these tariffs?
Well, it depends on how much of the increase in price that causes is passed through by importers. That's one of the few things in this stupid formula that was put out to support this tariff argument that makes sense, because there's the way that firms set prices is not like economic textbooks argue. What they do is they mark up their variable costs of production and work out a margin on that basis. So if they find they're going to lose market share to their rivals, they've got the possibility of dropping their margins, taking a lower level of profit, but still hanging on to market share. And I've seen one of Trump's advisors saying that that could be quite dramatic, that a 30% tariff might lead to less than a 1% change in prices, which is feasible. So the consumers won't necessarily feel it, but the groups that will feel it are the business sector, which is now going to find us making far less profit.
Right, and JP Morgan has increased its forecasts for a possible recession in the US. Do you agree with this likelihood?
Probably for different reasons, but yes, I do. I think we are going to see a recession, and it will be caused by government policy. The tariffs is one thing. The other objective that Musk and Trump both have of slashing the government deficit is based on a fallacy about how money is created, taught by economic textbooks, taught by mainstream economists. They're the last people you'd ask about what's going to happen. But by cutting out the deficit, they stop creating fiat money. There's less money circulating in the economy. That will cause a recession.
And President Trump wants to bring manufacturing back to the US with these tariffs, but a lot of the vital components needed for a lot of US produced products are usually imported. So how will the US industries navigate this?
Oh, it's going to be extremely difficult, but the basic idea of re-onshoring makes eminent sense, because outsourcing, which was sold as a way of being more efficient, actually ends up with far less efficiency and far less flexibility. This is one of the reasons that Musk's companies have done so well, because they've done the opposite. They've tried to source everything in-house. So it will ultimately be effective to do it that way. But this is the disruption that Trump is causing right now is not the best way to go about it. If he really wants to change the global system forever and be remembered for it, what he should do is bring back Keynes's idea of an international currency, not the American currency, but one created by the government system that Keynes called a bancor. Keynes could always call it a Trump, and then he'd have his name engraved on the planet indefinitely.
Right, Professor Steve Keen, we will have to leave it there. Thank you very much for your analysis.
You're welcome.
Now, some Asian markets have bounced back following Monday's sharp losses. Hong Kong's Hang Seng index rebounded from a 13% decline the previous session to trade 0.8% higher, while the mainland CSI 300 edged up 1.4%. Beijing has vowed to further retaliate if US President Donald Trump follows through on his threat to levy an additional 50% tariff on Chinese goods. Japanese stocks led gains, with both benchmarks rising over 6%, while Australia's ASX 200 rose around 2%. South Korea's kosdaq was up 1.1% and Kospi made marginal gains. Meanwhile, Vietnam's benchmark index lost more than 6%. Thailand's SET fell more than 4% to its lowest level since March 2020, and Taiwanese stocks also slipped by around 4%. For more on this, we're joined by Chris Weston, Head of Research at Pepperstone. Now, Chris, what settled investor jitters following Monday's panic sell-off?
Well, I think we'd seen a massive flush out of positioning. I think a lot of people wanted to wait out until we got the massive liquidations that we've been seeing on the cash open yesterday, certainly in Europe and Asia. There was a lot of false selling that took place. And, I think once that got past us, I think this sort of oversold nature came through and people sort of bravely took some of the shorts off the table. We saw CTA systematic funds taking shorts off, and we saw some organic buying of risk, and that pushed us higher. And obviously, when US futures were higher overnight, that sort of led us to build on the positions today. But I think, there was obviously that fictitious headline that we were going to see a 90-day pause. I think that really showed, whilst it was obviously fake news, it just showed us how ready the market was prepared to react should we ever see a positive headline. It just showed the level of buying interest that came through. The markets obviously did retrace from that point, but we are seeing some signs of positivity from Japan. We'll have to see what happens with Europe tonight. I know China's going the opposite way and they've pushed their tariffs up. But I think on a net basis, if you take out China, generally speaking, we are seeing signs that the market wants to come together. But I think the rally we've seen here is more of a bear market rally. Probably has a bit more juice, but it's a bear market rally rather than something that's going to be sustained longer term.
Right, and as you mentioned, futures are higher, both US and European, but there is still volatility across the board. What would help stabilize markets?
Well, I think structurally, there's a difference between a short-term rally like we're seeing at the moment and one of a structural, longer-term bull market and a re-establishment of that. For the structural bull market to come in, I think we obviously tariffs are the issue and fiscal policy is the issue there. So, I think we need to see some coming together. The market getting a bit more comfortable with what's happening in China. Europe will have to do something with their VAT rates to get a deal done there. And obviously Japan looks like they're doing something. But I think if markets see that 25% tariff rate of the US coming down or seeing signs of that, that would really give the market life. And then, of course, the Trump needs to re-establish and reinvigorate the market onto tax cuts and some of the other fiscal measures playing through. And obviously US earnings are coming up pretty soon. Short term, I think the data needs to come in better. We're not really going to see the April series, which is going to capture the new tariffs, really until the 23rd of April when we get the PMI numbers coming through. But better data will probably relieve some of these fears about recession risk that we've been seeing. But at the moment, I think a market going up is probably enough to do it, because markets that go up typically see people covering shorts. You get sort of a more momentum-based funds looking to chase this, and that will perpetuate the market up in a little bit of short term. But until those structural issues are reconciled and people can take a recession off the table, I think people will look to sell into this a decent rally here.
And now there are new threats both from Trump and from Beijing. How serious are these threats?
Well, looking at the price action today in China, it doesn't feel like it's too bad. But I think, there's obviously a bit of buying coming through from the national team in China today. They're obviously, with potentially 100% tariffs, they're not going to be selling too many goods to the US, and they'll probably look to reroute that to Europe. Question how much goods Europe are going to be buying from China as try and make up the difference. So I think China really needs to devalue its currency. All roads lead to a weak yuan from this point. So that's obviously a one for the FX traders. But obviously it is a big concern that you are seeing this tit for tat back and forth playing through. But for now, the market is showing it's pretty comfortable, as I say, but that's probably more repositioning. But we'll have to see if that can be sustained. I do think this relationship fallout between Xi and Trump is obviously a net negative for markets.
Right, Chris Weston, Head of Research at Pepperstone, thank you very much for joining us.
Pleasure, thank you.
Now a quick look at some of the other top business stories from around the world. Nippon Steel shares have surged more than 9%, riding on a wave of optimism from a broader recovery in Japanese markets. The rally follows US President Donald Trump's order for a fresh review of Nippon Steel's nearly $15 billion acquisition of US steel. This had previously been blocked by the Biden administration. Canada has filed a complaint with the World Trade Organization over US President Trump's 25% duties on car imports. The complaint contends that these tariffs violate legal agreements under the General Agreement on Tariffs and Trade, which sets the rules for international trade. These agreements were specifically designed to prevent trade wars, especially during times of retaliatory tariffs. Broadcom has announced it would buy back shares for up to $10 billion from now to the end of the year. The chipmaker, which supplies parts to Apple, forecasts strong second quarter revenue and hinted about new potential customers. The stock had been down 34% this year, part of a broader tech rout fueled by tariff concerns. And Spirit Airlines CEO Ted Christie has stepped down effective immediately, just weeks after the budget carrier emerged from bankruptcy. His sudden departure comes as Spirit looks to shed its bad reputation and rebrand itself as a premium airline. The company filed for bankruptcy last November after years of mounting losses, heavy debt and failed merger attempts. Welcome back. Donald Trump's tariffs have created unexpected turbulence across African financial markets. Over 50 nations are actively engaging in negotiations, reflecting widespread apprehension among investors. Some African countries are trying to find solutions to mitigate the impact of the tariffs. For example, Zimbabwe is adopting an innovative approach by suspending tariffs on US imports to stimulate trade. Yet the southern African nation grapples with an 18% tariff hike on other products, adding complexity to its economic landscape. The contrasting measures highlight Zimbabwe's urgent efforts to balance increased export opportunities against rising import costs. Lesotho is experiencing a severe export strain with a 50% reciprocal tariff affecting goods worth $237 million. In South Africa, a 31% tariff is already impacting the country's export dynamics, raising alarms over both trade and revenue. Both nations face daunting numerical challenges that threaten to undermine their economic stability and export growth in a highly competitive global market. Amid these challenging conditions, African governments are redirecting efforts towards diversification of trade. Countries such as Madagascar, which faces a 47% tariff on $733 million worth of exports, and Nigeria calling for enhanced intra-African trade, are leading the charge. This strategic pivot aims to build resilient economies by reducing reliance on volatile external markets and embracing new diversified trade partnerships. For more, we're joined by Eric Boachi-Yadom. He's a senior lecturer in banking and finance at the University of Professional Studies in Accra. Good to have you with us, Eric. Now, African nations are facing some of the highest tariffs from the US. What's been the response so far?
So, as you rightly mentioned, some countries are trying to adopt an approach to minimize the impact, like you mentioned in Zimbabwe, trying to bring down their tariffs on U.S. products to be able to promote trade. Now, in most part of the region, they are more of looking at a diplomatic approach by going into negotiation and find out ways that the tariffs could be dropped or will be reduced. But we know largely that Donald Trump won't back down. So many of the countries are also looking at diversifying and looking at trading with countries within the EU and China. And if you look at the data, African trade in China has gone up over the years in the region of over $296 billion. And so they are looking at ways of exploring that particular avenue to trade more with China, and also through the AFTA to strengthen the intra-Africa trade. You know, intra-African trade it has not gotten to where the region expected to be. A little over 200 billion. You know, more can be done if the policies and the AFTA implementation is successful. In as much as the U.S. tariff will impact the African trade in the short run, I think it's a blessing in disguise, that it's time that we have to look inward as Africans and try to trade among ourselves rather than overly relying on US to be able to dictate the level of trade and the terms of trade. So I think it has a short-term impact, but largely the diversification in our trade will help us as a country.
And what immediate steps are being taken to counteract the economic shock from these tariffs in the short term?
Yeah, so in Ghana, for example, I know they engaged the ambassador, U.S. ambassador to Ghana, to talk about how some of these things can be mitigated using the diplomatic approaches. The countries like South Africa and Nigeria are also using diplomatic means to be able to resolve these. But internally, it's like it caught them unaware, and many exporters have been complaining across the region and how this will be able will reduce exports, and ultimately also it will affect employment in key sectors. For example, go to Lesotho, their garment sector is heavily affected. If we come to Ghana, our export in terms of cocoa, is also heavily affected, as well as Cote d'Ivoire. So internally, they are looking at ways to diversify and look at other EU countries and Asian countries like China to be able to deepen their trade, to be able to reduce the effect. But I think one thing that US should also understand is that many of the export from Africa is serve as a primary input to the industry that they want to revamp and intend to produce more. So if you cut off Africa, which is a source of your raw material, you've cut off a huge part of your market, in terms of imposing trade tariffs to make product from Africa more expensive. So it's also a good call that Africans should look at how they can add value. If you look at the dynamics in the region, in the northern part of Africa, they export more value-added product. So if you look at the trade between the North Africa and the US, it's more of a trade surplus to North Africa. But when you come to the Southern Africa, it is more of a trade deficit, because we are exporting goods that are in raw state. So if we do not export these raw state raw product to the United States to feed their industry, the industry will suffer in the long run if they don't get the needed resources. And I know that in the US, they will not want to absorb. The trade partners may not want to absorb these tariffs and may be pushed to cut down the gains from exporters in exporting some of these products. So largely, it will also have effect on America, and we will suffer in short terms in terms of layoff and unemployment and all that. But it's also, we have to look at internal measures, how we can add value to our product rather than exporting gold and cocoa and cotton and garment in raw state, and we should add value to them, to be able to gain some other international players to buy from us, like the EU and China.
All right, Dr. Eric Boakye Yiadom in Accra, thank you very much for being with us.
Thank you for having me.
Well, that is all your business news for now. Thanks for watching.